Hello everyone and welcome to today's Mondac webinar in association with ATOZ Tax Advisors discussing the Luxembourg tax and transfer pricing update for 2020. My name is Dan Sampaio and I'm joined by a wonderful panel to take us through today's discussion. Keith O'Donnell is a founding partner and managing partner of ATOZ. A tax professional since 1988, Keith has experience in advising international groups on the design and implementation of global tax strategies. He is actively involved in several key tax international bodies, including the OECD's Trace Bag. Keith is chairman of the Luxembourg chapter of IFA, chair of the ALFI Tax Commission, vice chair of Digital Europe's Tax Committee, and member of other Luxembourg advisory and industry bodies. Keith is also a tax and board member. Oliver Hoor is a partner in the International and Corporate Tax Department at ATOZ. A tax professional since 2003, Oliver has experience in Luxembourg and international taxation with a focus on alternative investments, private equity, real estate, sovereign wealth funds, hedge funds, mergers and acquisitions, and multinational groups. He advises clients on all direct tax aspects regarding deal structuring, maintenance, reorganizations, and exit planning. He also holds the titles of Head of Transfer Pricing and of the German desk. Now, before I hand over to the panel to begin today's webinar, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page. The panel will endeavour to answer as many questions as possible during the Q&A session, but please do reach out to them after the webinar for any additional information. It's now my pleasure to hand you over to Keith and Oliver to begin. Thank you.
Thank you, Dan, and welcome everyone. As Dan read out all the things I'm supposedly doing, I wondered how I had time to do webinars, but here I am anyhow, and delighted to be here and delighted that you're all here, albeit virtually with us. The format of this webinar is to really take you through changes that have taken place over the last 12-18 months. As any of you who spend time in this field will know, it's been a busy 18 months. We've had initiatives driven primarily coming on the international level from the OECD and then being translated into European law in European directives and then finally implemented into Luxembourg law. Although we are technically on a level playing field between the OECD, Europe and Luxembourg, as we'll see in some of the implementation matters, there are subtle regional and national differences which make it quite interesting. It's equally worth pointing out that as the international landscape evolves, Luxembourg tax law is also evolving constantly, whether it's by way of legislation or particularly by jurisprudence, as many more cases are being litigated than was traditionally the case. Partly because, frankly, quite often it suits the tax authorities to get clarity on a matter via litigation, so it's proved to be quite helpful. And basically, there's been a continuing evolution. The general slant of Luxembourg tax changes has been to try to be as business friendly as possible, while strictly respecting the constraints set down by European directives in particular. But as we'll see, even with that business-friendly attitude, things have tended to get, unfortunately, a bit more difficult and a bit more technical over time. And while there's a limit to what any European member state can do to try and limit this, I think we're not alone in hoping that over time, the pace of change will slow down slightly and we can bed down the changes that have been made and concentrate on working with those going forward. So with that few words, Oliver, why don't you take us through the agenda and what we're going to be talking over the next hour and a quarter, and then hopefully the last part we'll leave open for questions from the audience.
Yeah, thank you, Keith, for the introduction. Probably also some select statements to begin with in terms of organization. So the presentation should last approximately 1 hour 15. That would bring us to 4:45 p.m. And then afterwards we still have like 15 minutes to answer all your questions. You will also receive a handout with comprehensive publication on all the topics discussed today. So that means you will have the possibility to read through all of that in all detail. And also probably one general comment, I have been seeing that the audience is very international. So that means like not only people that have a strong focus on Luxembourg taxation. So I will try to also provide a bit more context than I would usually do to a Luxembourg only audience. In terms of contents of today's presentation, we will be speaking about Luxembourg tax law changes. Then we have seen like 3 important case law from the Luxembourg Courts. We will also look into case law of the Court of Justice of the European Union. So there we had like 3 very positive decisions end of last year. And we will also provide you with an overview of all the developments that are currently happening at EU level, as they are working on many different initiatives. Next slide. So looking at the Luxembourg tax law change that we will be looking into more detail. First of all, we received clarity in the 2023 tax law changes in regard to the application of the reverse hybrid mismatch rule. Then we will be looking into the interest limitation rules, and here more specifically into the potential application of the standalone entity exception when it comes to securitization vehicles. Sometime mid of last year, we also received an extended FAQ on DAC 6 by the Luxembourg tax authorities. Here we had a bit of confusion in regard to say like some of the guidance received, and we will try to bring a bit more clarity here. And then last but not least, the filing deadline for corporate tax returns has been formalized to be the 31st of December of the following year. That was always administrative practice, but now it has been formalized, and so that's a positive change. Next slide. So the reverse hybrid mismatch rules, and probably also to provide some background here, is part of the implementation of the Anti-Tax Avoidance Directive 2. The reverse hybrid mismatch rules apply as from fiscal year 2022. And in principle, what is the reverse hybrid mismatch rule about? It's about like an entity that would be classified as transparent from a Luxembourg tax perspective, but as opaque from the perspective of the investors. Probably just here to see the chart that we have on the left-hand side. This is probably a typical investment structure where we have like investors investing via a Luxembourg here RAIF, Reserved Alternative Investment Fund, established in the legal form of an SCSP, that means a special limited partnership. And the fund would invest via a Luxembourg master company and Luxembourg or local property companies into property companies. So this would be a typical setup of a, say like a pan-European real estate fund, for example. And here the fund vehicle established in the legal form of a limited partnership that is transparent from a Luxembourg perspective could give rise to concerns from a reverse hybrid mismatch rule perspective if the investors would be resident in a jurisdiction that treats the partnership as opaque. And what can happen in these situations? I mean, given that from a Luxembourg perspective, a partnership is transparent, so we would attribute the income to the investors. However, from the investor perspective, they would treat the vehicle as opaque and therefore would not consider to receive the income. And that can result in double non-taxation or long-term tax deferrals. And that is what the reverse hybrid mismatch rule tries to eliminate. And while I mean, this rule needs to be considered in the context of multinational groups. However, given that Luxembourg is a major fund location, and therefore we also always consider the impact on the Luxembourg fund industry, this is unfortunately also something that we need to consider in a fund context when we have funds established in the legal form of a partnership or an FCP, which is a fund in contractual form that is also treated as fiscally transparent. Next slide. So the important clarification that we got is in regard to the application of the related party test. which somewhat defines the scope of the reverse hybrid mismatch rule. And one must already say that the related party test in regard to the reverse hybrid mismatch rule is more restrictive than the related party test in regard to the standard hybrid mismatch rules, because here it's say like the related party test is met if we have like non-resident investors in the Luxembourg vehicle that are resident in a jurisdiction that treats the Luxembourg entity as opaque. And that is a requirement that is not relevant for the application of the hybrid mismatch rules. So here, it's only non-resident associate enterprises that are resident in a jurisdiction that treat the Luxembourg vehicle as opaque. Then we have a threshold requirement of at least 50% in terms of voting rights, capital ownership, or profit entitlement. And that is the clarification, that the hybrid nature of the entity must be the reason for the non-taxation. And that is an important restriction of the potential scope of application of the reverse hybrid mismatch rule. Next slide. Because that means that the tax status of the investor can discharge the potential application of the hybrid mismatch rules. What is, say, like a tax-exempt investor for the purposes, say, like of this change? So it would be a tax-exempt investor that is resident in a high-tax jurisdiction, for example, a pension fund that benefits from a special tax regime. It could be an investor that is resident in a jurisdiction that does not levy taxation, for example, the Cayman Islands, or it could be an investor that is resident in a jurisdiction that adopted a mere territorial tax regime, where the income from the entity would be treated as tax-exempt foreign source income. So while, say, like before this change, I mean, we knew already that we would exclude, when determining the potential tax adjustment, that we would exclude this type of investor from the tax base. However, having these or now the clarification that tax-exempt investors already need to be excluded, say, like at the level of the related party test, meaning from the scope of the reverse hybrid mismatch rule, that will large or further restrict the potential application of this rule. Next slide. Now, giving regard, say, like also to like more specifically to funds, and we have here, because I mean, in principle, we have like associated enterprises that always need to be aggregated for the purposes of the related party test. However, we also have the concept of acting together, which means that potentially unrelated parties need to be aggregated for the purposes of the related party test if they are acting together within the meaning of this concept. Next slide. Now, when it comes to investment funds, or the Luxembourg legislator adopted a de minimis rule. So then the question is, what is an investment fund for the purposes of the de minimis rule? The definition says that we are speaking about a collective investment undertaking with a defined investment policy, and which raises capital in order to invest the capital in accordance with that investment policy. So it means we have a very broad definition of what an investment fund is. So it could be a Luxembourg or foreign funds, closed-ended or open-ended funds, listed or unlisted, and regardless of whatever legal form the entity has. Next slide. And so that means when thinking about do I need to aggregate otherwise unrelated parties for the purpose of the related party test, we can distinguish between investors that have an investment stake below 10% or 10% or more. So if you have investors that own less than 10% in the fund, the de minimis rule applies, and that means that in principle these investors do not need to be aggregated. And if the tax authorities would take a different view, they would have the burden of proof to make the case that these investors would be acting together. If you have investors with 10% or more investment in a fund, Here it needs to be proven on a case-by-case basis by the taxpayer that these entities are not acting together. So typically one would look at are these investors like part of the same group, or say like managed by the same asset manager. That could be a hint. But I mean, one need to say like prepare the files in order to be able to answer the question should they ever be asked by the tax authorities. Next slide. Then thinking about the tax consequences when the reverse hybrid mismatch rule applies. I mean, here we so like if the rules apply, we would have a partnership that is otherwise not a corporate taxpayer. But if the rule applies, it would be deemed to be a corporate taxpayer, so like a fiction. And then the question is like, yeah, what should be the taxable basis of the partnership or the transparent vehicle? It should be only that what is necessary in order to eliminate the mismatch outcome. So that means that we need to exclude certain investors. I mean, even if we include a certain associated enterprise for the purposes of the related party test, when determining the taxable income, we again need to exclude some types of investors. And here, for example, if we have like investors that are taxable and that treat future distribution as taxable income, these investors would not trigger a mismatch outcome and therefore not would not be included in the tax base of the entity. The same would apply with respect to investors that are taxable and that would apply a mark-to-market or fair value accounting treatment, and where tax follows accounting, and therefore the income would be included in the ordinary income of that investor. And last but not least, if you have investors where the income is included on grounds of the application of controlled foreign company rules.
Yeah, it's probably fair to say, Oliver, that with these exclusions, the category of investors left where this will actually bite is going to be very small.
Yeah. Indeed, and the thing is, like in practice, why we have this rule. I mean, first of all, one always need to analyze proactively, like do these rules apply or not, and if one cannot exclude the potential application of the rules, or say like if the rules would apply, we know we do not only have exclusively say like good investors for the purposes of excluding the potential income from the tax base, then one would need to say like think about structure alignments in order to manage that position. So, but indeed, like in a fund context, that is very much shrinking down the potential scope of application. Next slide. Another thought about like a carve-out that has been implemented with respect to collective investment vehicles. So like there's a specific rule that says that CRVs would not fall within the scope of the reverse hybrid mismatch rule, or would be excluded from the scope. Now the question is, how is a CIV defined? It's defined as an investment fund or a vehicle that is widely held, holds a diversified portfolio of securities, and is subject to investor protection regulation. Now, if we think about that definition and we read widely held, assumingly a CIV that is widely held will not meet the related party test, because if you would have say like 15 investors that each own less than 10%, we could rely on the de minimis rule, and we would not have like 50% or more related parties, and therefore this rule should not apply. So therefore the question is like, what is really the scope of this rule? The commentary to the law introducing the hybrid mismatch rule and the reverse hybrid mismatch rule provided that Luxembourg alternative funds, regulated funds, should come within the scope of this exemption. However, we have been witnessing that the Luxembourg tax authorities seem to have a more restrictive view on that. However, I guess again, like this CRV exemption seems to be very limited in scope, and therefore normally we do not rely on that. Next slide. Then the question is, like, if we would be kind of in a worst case situation where we cannot exclude the potential application of the reverse hybrid mismatch rule, and where the analysis of the tax position of the investors would not result in an exclusion of all the investors. The question is, like, do we have, like, say, like another argument to say that a fund should be tax exempt? And if we might have funds that are subject to a special fund regime, like, for example, the specialized investment fund or the reserved alternative investment fund. And here we have, like, a special fund regimes that provide for a specific exemption from corporate income tax, municipal business tax, and net worth tax. And now the question is, like, should this not apply in case of a potential application of the reverse hybrid mismatch rule? And here our conclusion is that this exemption must apply, because in principle we have here, like, a corporate income tax as the general law, and then we have the fund law that provides for a specific exemption, and that tax exemption provided in the fund law must take precedence over the general corporate income tax code. So just in full transparency, some people take a different view and say, like, yeah, because we are speaking about EU law and ATOZ would take precedence over Luxembourg law. That argument could only hold true if one could make the case that ATOZ would seek to have, like, funds that are otherwise tax exempt to become taxable. That wouldn't make any sense. And also when we compare, like, funds in corporate form that in principle are subject to corporate income tax, municipal business tax, and net worth tax, and only exempt because of that specific exemption. Now to say, like, if we have a partnership fund and then we have a fiction here that they are deemed to be a corporate taxpayer, and then that exemption should not apply, would not really make sense. Apart from asset managers are not choosing partnerships in order to make any kind of tax planning, but rather it's the flexibility provided by a partnership fund that is decisive for choosing this legal form. Next slide. In the case when the reverse hybrid mismatch rule would apply, distributions by the entity would not be subject to Luxembourg withholding tax. And with regard to municipal business tax, the reverse hybrid mismatch rule would not provide for any change. So it means, like, partnerships can be subject to municipal business tax if they either perform a commercial activity or if they have a Luxembourg general partner that owns, like, more than 5% in the partnership. In this case, the entity would be commercially tainted. If we think about, like, fund vehicles are AIFs and perform wealth management, and therefore not a commercial activity, and would therefore not be subject to municipal business tax. Next slide. So the law introducing the reverse hybrid mismatch rule also provides for an explicit exemption from Luxembourg net worth tax. And last but not least, given that partnerships and FCPs are treated as fiscally transparent, so only with respect to corporate income tax, the reverse hybrid mismatch rule would have the effect that the entity is deemed to be a corporate taxpayer, but it would not change anything else with respect to the tax transparency, because for all the other rules we would look through the vehicle. Next slide. Now we prepared, like, 2 case studies in order to see how this rule might apply in practice. And probably just to walk you through these, like, here we see, like, yeah, the investors in the fund and where they're resident, what is their shareholding percentage. So we have, like, investors 1 to 3 that are part of the same group. So it means in principle we need to aggregate them because they are associated enterprises. The other investors all own less than 10% in the fund and are otherwise unrelated parties. So it means these investors could be excluded on grounds of the de minimis rule. That means now we need to focus on the 3 investors that are part of the same group. This could be, for example, like if you have like say like a group of insurance companies where like the entities that are resident in different jurisdictions where to make investments in a common investment vehicle. So investor 1 is resident in Germany, where the Luxembourg fund is viewed as transparent, and investors 2 and 3 are resident in France, where the Luxembourg Partnership Fund is viewed as opaque. So each of these investors own 20% in the fund. So now thinking about the potential application of the reverse hybrid mismatch rule, so we need to check the related party test. So we only would think about like associated enterprises that are resident in the jurisdictions that views the Luxembourg vehicle as opaque, so that means France. So we have investor 2 and 3 that would need to be aggregated. We have 40%, 40% is less than 50%, therefore the reverse hybrid mismatch rule would not apply. So here we do not need to further analyze because we can already make the case that we do not have 50% or more associated enterprises. Next slide. Now, as a slight variation to the previous example, now we consider that investors 1, 2, and 3 are part of the same group and all resident in France. They each own 20% in the fund. And that means now, for the purpose of the related party test, we need to aggregate these 3 investors. That means we have 60% associated enterprises, 60% is more than 50%. So in principle, the reverse hybrid mismatch rule applies. Now the question is like, what should be the taxable income of the partnership? Now we know that all the investors are taxable, so tax status is taxable. Investor 1 adopts or applies a mark-to-market fair value accounting treatment. That means the income is considered each and every year and also included in the tax base of the taxpayer. And investor 2 and 3 would tax the or include the dividend distribution of the entity upon distribution. So that means all the investors are ultimately either directly or upon a future dividend distribution subject to tax on the income derived via the vehicle, and therefore there's no mismatch outcome to which the reverse hybrid mismatch rule could apply. So actually, also in the handout, you will find like a comprehensive publication on this, and I have been thinking about different constellation. Actually, in practice, it's even difficult, say like considering real life cases to construe a situation where this rule might apply in practice. One thing where we have been seeing it is like when you have like a feeder fund for like a single investor, and then that investor would be resident in a jurisdiction that treats the feeder funds that is established in the form of a partnership or an FCP as opaque, and future dividend distributions would be treated more favorable than the income that would be received from the main fund. So that might be a situation where this rule can be relevant in practice. Next slide. Now looking at the interest limitation rule, and here in particular in regard to securitization vehicles and the potential application of the standalone entity exception. Probably just to give you a quick introduction to the interest limitation rule. So in principle, the interest limitation rule would provide for a limitation of the deductibility of exceeding borrowing costs to 30% of the EBITDA. So exceeding borrowing cost means one incurs more interest expenses than one realizes interest income. So that means if we perform, for example, financing activity, or a Luxembourg company performs financing activity, such Luxembourg company always need to realize a positive finance margin That means one realizes more interest income than expenses. Therefore, there are no exceeding borrowing costs, and this rule does not apply. However, if we realize income other than interest income that is taxable, then we might have a problem if we can deduct interest expenses only up to 30% of the EBITDA. Luxembourg also adopted a 3 million safe harbor. So it means like up to 3 million exceeding borrowing costs, there will be no limitation. However, if you think, for example, in a fund context, like big investments, 3 million might not be sufficient. Then the question, what are borrowing costs? Borrowing costs, we have a broad definition. Technically, we only have a list of examples, which is not say like conclusive, but it's extremely broad. On the other hand, we have no definition with respect to what interest income or economically equivalent revenues would be. However, given that both concepts should be mirroring concepts, both interest income and interest expenses should be interpreted very widely. Next slide. And so, and that is a topic that we have been discussing about actually since the ATOZ 1, like the anti-tax avoidance directive, has been released because the elephant in the room was like investments into distressed debt or non-performing loans. Probably just to give you a little background about that particular category of investments. So investments into distressed debt, that means like debt that is owed by say companies in difficult situations. One would assume to buy the debt, for example, for 60 cents on the dollar, with the aim of realizing 80 cents on the dollar. Now, when or the difference between the 80 cent and the 60 cent will likely be treated as a capital gain from a Luxembourg accounting perspective, and tax follows accounting. So that means we would not realize interest income, but we would probably have like a debt instrument. And here, it's like in the group chart, we see like a Luxembourg fund investing via a Luxembourg company into a distressed debt portfolio. If here we would have like a tracking loan, which means the income or the interest charged under this loan depends on the performance of the underlying investments, and one would leave the Luxembourg company with an arm's length remuneration. However, if the income or the interest expenses exceed like 3 million, given that all the income realized would rather be classified as capital gains, above 3 million, we would have or would face this 30% EBITDA limitation. And that means the Luxembourg company would be subject to tax on the income, probably like up to 70%, at a tax rate of 25%, resulting in an effective taxation of 17%, which would obviously be problematic. Next slide. Now, so like one way of making investments into distressed debt would be like through a Luxembourg securitization vehicle. A Luxembourg securitization company is subject to Luxembourg corporate income tax, municipal business tax, and minimum net worth tax. So it means like the interest limitation rule would also apply to the Luxembourg securitization vehicle, as in principle not subject to transfer pricing, so in principle does not need to realize any significant taxable income. So that means we would in principle face the same problem when it comes to investments into distressed debts, that we might have a limited deductibility of the interest charge and here we see the investors investing via notes into the Luxembourg securitization vehicle, and so the interest charged under the notes would in general be or could be subject to limitations. Now we have like one exception to the scope of the interest limitation rule, which is the standalone entity exception, which so like when we follow the work of the OECD on BEPS Action 4 in regard to interest limitation, I mean, the standalone entity exception has been introduced for securitization vehicles that have been found to have a useful role in the so like financial architecture. And the standalone entity exception would apply if an entity has no associated enterprise with 25% or more, or investors of 25% or more. And so one solution that we found in order to rely on this standalone entity exception would be a situation that we often see, that the participation in the Luxembourg securitization vehicle would be held by a trust. And typically we have a minimum share capital, say like 12,000 euros of a standard Luxembourg company. And the trust would be the legal owner. However, there would be beneficiaries in the trust. And so typically these beneficiaries are charities. And if we would have here like 5 charities that would each receive like 20% of the income derived from the participation, that would make these charities like the economic owners, and therefore we would be deemed to only have like 5 investors with 20% each, and the standalone entity exception should apply. And probably to go back why we would be looking at the beneficiaries. So under Luxembourg taxation, the fundamental tax principle is that if legal ownership and economic ownership deviate, then we need to look at the economic ownership. And so that would be here the 5 beneficiaries of the trust, that is merely the legal owner. And so therefore here we could then rely on the standalone entity exception, and the Luxembourg securitization vehicle could deduct all the interest expenses incurred under the notes issued to the investors. Next slide. Now looking at guidance that we received in regard to DAC 60 mandatory disclosure regime, and probably also to put here a bit of background. DAC 6, or the mandatory disclosure regime, aims at providing tax authorities with early information on potentially aggressive cross-border arrangements. The regime is built around a number of hallmarks that are features of arrangements, and many of these hallmarks are subject to an additional threshold requirement, which is the main benefit test. And the main benefit test is meant to filter out irrelevant reporting. Now, the Luxembourg tax authorities provided an FAQ where they clarified some of their views in regard to the mandatory disclosure regime. This FAQ has been updated last year in May, I believe, and it raised, or the examples that have been included in the FAQ raised some questions on the part of some Luxembourg advisors, because we are speaking here about, like, in particular, we are speaking here about like one hallmark, that's hallmark E3, that would trigger automatic reporting obligations and is not subject to the main benefit test. So that means, like, yeah, I mean, it's really important to clearly interpret this this guidance and this hallmark. So what happened is that the Luxembourg tax authorities included like 2 examples where hallmark E3 would not apply, and that was confusing people, like what the scope of this hallmark might be. So the first example was a Luxembourg company that would transfer its seat abroad, and here they say that if the then foreign company would keep a Luxembourg permanent establishment where all the assets of the former Luxembourg company would be kept, then this hallmark should not apply. I mean, it's a rather exotic transaction in practice, but I mean, to take one step back, in principle, the example does not really make sense, because if we have a Luxembourg company where only the seat is transferred abroad and the place of effective management would remain in Luxembourg, that would technically still be a Luxembourg company. We could not even have a Luxembourg permanent establishment in a treaty context. So that means this example does not really make sense, because just transferring the seed abroad would not make a Luxembourg company a foreign company. This is because in tax treaties we rely on the so-called corporate tiebreaker in order to determine in which jurisdiction an entity is resident. And if the seat and the place of effective management are not in the same jurisdictions, then it's the place of effective management that is decisive for the determination of which jurisdictions is the resident state. Next slide. Another example related to a cross-border merger, and here the same thing. We have a foreign company owning a Luxembourg company, and if an upstream merger is performed and the foreign company keeps a Luxembourg permanent establishment with all the assets of the Luxembourg companies, then hallmark E3 should not apply. Again, rather exotic in practice, but now the question is like, yeah, what does that mean for liquidations and cross-border mergers? So the real question was like, yeah, does it mean that now we need to report each and every liquidation of a Luxembourg company? Next slide. And here taking one step back and looking into the scope of hallmark A3. So hallmark A3 is a transfer pricing hallmark, and would apply if following a business restructuring, the EBIT of the entity would drop by 50% or more over the next 3 years according to the business plan. So that is basically what the hallmark says. Now, like for tax people, I would say like virtually everything might be a business restructuring. So be it like a granting of a loan, repayment of a loan, increasing of the loan. But from a transfer pricing perspective, one need to see that a bit more restrictive. And here we have like guidance in Chapter 9 of the OECD transfer pricing guidelines. So typically we would think when we speak about business restructuring, about like manufacturing and distribution, and here like different business models adopted by multinational groups. And here, as a tendency, the more functions, risks, and assets an entity has, the more remuneration would be expected at arm's length. And if one then strips like functions and particular risk from one entity and shift it to another, that will obviously have like an impact on the profitability of the entities at arm's length. But if we think about like entities that will be liquidated, I mean, usually, so like when we speak about Luxembourg companies are liquidated because there's no purpose anymore for these entities. So typically one would expect these entities not to have any meaningful assets anymore before the liquidation that could result in any significant revenues. So therefore, the 50% drop in EBITDA test should not be met, because I mean, if before the liquidation, the business plan would show like, yeah, we would virtually not realize any taxable income in the next years, then like the 50% drop cannot be documented. Yeah, so and therefore that leads to the conclusion that the liquidation of an entity following a transfer of assets should only be reportable if it's part of a business restructuring. But that is not merely like, say, like in a fund context, one sold the asset, liquidates the entity, and that should then be a business restructuring. Next slide. So looking here at one example where we have a Luxembourg fund investing via a Luxembourg master company and the Luxembourg company into assets. So the assets have been sold, the cash has been repatriated, and now the Luxembourg company should be liquidated. I mean, here there would already be no reporting obligations because we do not have any cross-border dimension, because it's a Luxembourg master company liquidating a Luxembourg company. So it's a Lux transaction, and therefore the mandatory disclosure regime would not be applicable. Next slide. And now as a variation, if we would have here a Luxembourg company that is owned by a foreign company, so first selling the assets to a third party, and afterwards, after repatriating the cash to the foreign company being liquidated, here we would have a cross-border dimension, but here the Luxembourg company would not be expected to realize any meaningful taxable income over the next years. So therefore, one cannot establish that there would be a 50% decrease in any meaningful EBIT, and therefore this hallmark should not be met. So that would be the update on the Luxembourg tax law changes. Now moving to Luxembourg case law. Next slide. So here we have like 3 important decisions over the last 6 months or so. So one decision was a decision in regard to an interest-free loan and declassification as debt or equity for Luxembourg tax purposes. Then there was a decision in regard to the tax treatment of account 115, which is a specific equity account that provides for a very flexible way of contributing equity to a Luxembourg company without issuance of shares. And last but not least, we had a decision in regard to so-called classes of shares and the treatment for Luxembourg tax purposes. Next slide. So beginning with the first decision and in regard to the classification of an interest-free loan. So here on the left-hand side, we see the investment structure. So we are talking about an investment that has been implemented in April 2016. It was also about like investments into distressed debt. So here we had a Cayman company investing via Luxembourg parent company into a Luxembourg subsidiary that then should invest into distressed debt. The Luxembourg parent company has been financed by a profit participating loan, and Lux Parent Co. financed Lux subsidiary with a mixture of equity and interest-free loan. And here we had, according to the description in the case, like 10% equity and 90% interest-free loan. The funds have been granted back in April 2016, and the interest-free loan has been documented in December 2016. Furthermore, it was intended to apply the fiscal unity as from 2016. That means so like a regime that is also known as fiscal consolidation. That means we would aggregate the taxable income of Lux Parent Co. with the taxable income of Lux subsidiary and then be taxable only on a consolidated basis. So here that would mean we would have Lux subsidiary realizing capital gains in regard to the investments into distressed debt. Lux subsidiary would not incur any expenses, so there are no expenses under the interest-free loan. And at the level of Lux Parent Co., the profit participating loan arguably would more or less like track the income realized by the Luxembourg subsidiary minus an arm's length remuneration. So that means in the fiscal unity, both entities would be subject to tax on an arm's length remuneration. So that was the idea. However, the taxpayers forgot to file the fiscal unity request on time. So it means in 2016, the fiscal unity did not apply. And so that was obviously then a problem, because then we have like Lux subsidiary realizing all the income. We have the Luxembourg parent company realizing all the expenses. But Lux subsidiary would be fully taxable on all its income. And so what then has been considered is that, okay, we have here an interest-free loan granted by Lux Parent Co. to the Luxembourg subsidiary. At arm's length, we would expect an arm's length remuneration or interest rate to be applied on that loan. And therefore, we perform a downward adjustment at the level of the Luxembourg subsidiary, corresponding to the arm's length remuneration under the interest-free loan. And at the level of the Luxembourg parent company, we would perform a corresponding upward adjustment. And that would then have the same result. So it would mean on a standalone basis, Lux subsidiary and Lux Parent Co. would realize an arm's length remuneration. Next slide. So unfortunately, the Luxembourg tax authorities considered the interest-free loan as equity, as a hidden capital contribution, and therefore rejected the tax adjustments, the upward and the downward adjustment made in regard to the interest-free loan. The fiscal unity regime has been granted as from 2017 when the request has been filed. However, with the classification of the interest-free loan as equity, the fiscal unity regime would fix the income tax side, because we would then aggregate the income realized by Lux subsidiary and the expenses incurred by Lux parent co. However, we would still have like the net wealth tax position at the level of the Luxembourg subsidiary. That would be problematic, because if we have like taxable investments in distressed debt and we finance these by equity, we would be fully subject to net wealth tax at an annual rate of like 0.5%. Next slide. The Luxembourg Administrative Tribunal, so that's the court of first instance, decided in favor of the Luxembourg tax authorities. They agreed to reclassify the interest-free loan into equity based on the concept of hidden capital contributions. Given that the court considered that the interest-free loan should be equity, they did not analyze anymore whether the transfer pricing analysis was correct. Unfortunately, and you find like a comprehensive publication in the handout on that, the court has been mixing like the classification of financing instruments and the concept of hidden capital contributions. Next slide. Because I mean, here on the left-hand side, we see all the features of the interest-free loan. And in principle, what one has to do is first one need to analyze all the features of the instrument, and then one need to make an overall assessment whether this instrument is more equity or more debt-like. Because in practice, we might have like financial instruments that have a certain label and have like or combine features of equity and debt, but then one need always to analyze all the features and make an overall assessment: is it debt or is it equity? And here we have like three features that are either equity or rather equity-like. For example, the remuneration, like interest-free, is rather equity-like. Then there is a loss participation, so there was a limited recourse clause. So that is an equity feature. And the loan also provided for an explicit provision that it could be converted into, like in full or in part, into equity of the entity. So this is rather an equity feature, because if you state it or not, you can, or a shareholder can always contribute or convert like a debt instrument into equity of the entity. However, all the other features are debt features, so therefore, I mean, we reached a conclusion fairly clearly that this isn't a debt instrument. So then the next question is, can the concept of hidden capital contribution apply? I mean, that this concept could apply if the shareholder and investor would have waived the interest-free loan. However, a waiver would require, say, like an explicit statement by the shareholder. And given that the interest-free loan has been documented beforehand, obviously they seem to have forgotten about that when implementing the investment structure. They expressed that they wanted to have an interest-free loan and they did not want to waive the loan. So therefore, we reached a conclusion that it should not be a hidden capital contribution. Now, one concept that has not been considered by the court, but just to be complete, there is another concept of hidden capital, which would apply if there would be a legal or regulatory requirement to finance an entity by equity. So it was imperative to finance with equity rather than with debt. Then one could also reclassify a debt instrument into equity on that grounds. However, this imperative situation was not present here, so therefore this concept cannot apply. That means we are speaking about a debt instrument, an interest-free loan that need to be, in principle, need to be remunerated at arm's length. And here we have like Article 56 of the Luxembourg Tax Law that provides for transfer pricing adjustment, notably upward and downward adjustments. And so therefore, the court unfortunately was wrong in its decision here. So the decision is currently with the administrative court, which is the court of second instance, and we would be expecting the decision of the court in the next coming months. So, I mean, this is then obviously a very important decision because it's, first of all, it's the application of very fundamental principles. Interest-free loans are commonly used in Luxembourg, and having uncertainty about such an important topic is not so positive. Next slide. Then we had another decision in regard to the tax treatment of account 115. Where we just to look here at the situation. So we had like an investor of a, say like Luxembourg company. And here the topic was around like dividend distributions, because dividend distributions by a Luxembourg company are in principle subject to a 15% Luxembourg withholding tax. However, the Luxembourg tax code also provides for a dividend withholding tax exemption in case of qualifying investors, which are typically companies resident in a treaty jurisdiction. I mean, there's more, but just to give you an idea. Then other requirements are a minimum shareholding requirement, which might either be a shareholding of at least 10% or a shareholding with acquisition cost of at least 1.2 million. And furthermore, the investor must hold or commit to hold the participation for an uninterrupted period of at least 12 months. So the question of the case was a situation where we had an investor that owned like a shareholding of less than 10% and therefore wanted to rely on the 1.2 million minimum shareholding requirement. And what happened here is that the investor acquired the shareholding for less than 1.2 million, then made an additional contribution into account 115. So that's an account in the Luxembourg select accounting schedule, which is named equity contribution without issuance of shares. So it's very flexible. It's literally like a 1 or 2 pager document in order to contribute into the account or to repay part of the equity contribution. Now the question was like whether this additional contribution into account 115 would need to be considered for the purposes of the 1.2 million minimum shareholding test. And next slide. And here the position of the tax authorities was that this should not be the case. So they would only consider the initial acquisition costs of the shareholding, but not the additional contribution to account 115. And therefore, the dividend withholding tax exemption has not been applied, but a 15% Luxembourg withholding tax. And unfortunately, the court, the administrative court of second instance, confirmed the position of the Luxembourg tax authorities. Next slide. So now, like looking at the practical implications of that. So like in practice, one might say that this situation should normally not be so relevant. Very often we have 100% shareholding percentages or clearly above 10% when it comes to relying on the Luxembourg dividend withholding tax exemption. So it means we are speaking about a very particular situation. So we speak about an investor with less than 10% shareholding percentages. On top of that, acquiring a participation of less than 1.2 million and then making a contribution to account 115. So that's so like already like nearly a construed situation. However, I mean, thinking it to the end, say like this decision and the way like the contribution to account 115 has been considered might trigger intricate tax issues. Also with respect to the application of the participation exemption regime, where we would also need to think again about like, yeah, how do we view contributions to account 115? Now we know that there's another decision in front of the court, the administrative court of second instance, and we also believe that the court might have understood the say like the side effects of this decision. So we hope that the new decision might be going in a different direction. Next slide. Then another important decision, very recent, from the end of January, is a decision in regard to the tax treatment of classes of shares. Probably to give you a little background, like classes of shares are often implemented by Luxembourg companies, and classes of shares can be redeemed at fair market value, and as such provide for the possibility of Luxembourg companies to repatriate cash to the investors. Like a redemption and cancellation of a class of shares would generally be treated as a partial liquidation, and partial liquidations are not subject to Luxembourg withholding tax. And so therefore it's very important how a redemption and cancellation of a share class is treated for Luxembourg tax purposes, be it on one hand, say like dividend payments, or on the other like capital gains. Yeah, and here in the case, we had a Cayman company investing into a Luxembourg company that is financed by 10 classes of shares. Here, like one class of shares has been redeemed and cancelled. Probably also like a general word, like classes of shares can also be designed in very different ways. I mean, you can have like tracking classes of shares, you can have like classes of shares that are tracking class of shares tracking particular investments, or you can have like different classes of shares tracking like all the income of a company, and that would be a type of classes of shares that we see here. And then typically different classes of shares provide for different economic rights to the investor. Next slide. So the Luxembourg tax authorities, so like in this case, when the Luxembourg company redeemed cash to the Cayman entity through a redemption of a class of shares, like the last class, meaning share class J, has been classified as a hidden dividend distribution for the entire amount, and the Luxembourg tax authorities levied 15% withholding tax on this hidden dividend distribution. Next slide. Now, the decision of the court was rather positive. Also, classes of shares is a topic that was a bit subject to debate over the last few months and years. And so therefore, this decision brought like a welcome clarification, because the court clearly stated that the redemption of a class of shares would not be a hidden dividend distribution as such, unless the redemption price would exceed the fair market value of the class of shares. The court seemed not to consider abusive that there's only one shareholder owning all the share classes, or that the redemption of a class of shares occurred shortly after the implementation of the investment. Now what happened is that the court referred the case back to the Luxembourg tax authorities to determine what would be the fair market value of the class of shares, in order then to determine if there is an exceeding amount, or if the redemption price exceeds the fair market value, and therefore there would be a hidden dividend distribution. So that analysis would be consistent with our analysis. Now the only question is like how to determine the fair market value of a class of shares, and so there are in principle like two ways one could consider. The one would be that one follows the articles of incorporation, and normally one has like much flexibility in the way one allocates like different rights to different classes of shares, and normally one should also then follow this mechanics, and also when implementing classes of shares, there's no like arm's length standards that need to be considered. Instead, Luxembourg companies can fairly freely decide like which class of shares should track which type of income or have like which economic rights, and then in principle we need to follow that. And only if then afterwards we determine the redemption price in accordance with the articles of incorporation, and then we see like, okay, the redemption price is higher than the fair market value, meaning the price that it should be based on the articles of incorporation, then we could say that we have a hidden dividend distribution. Another way to look at it would be looking on a pro rata basis, that if we have like one share class that has like or represents 5% of the overall share capital, that one then would say like, yeah, okay, it should only be 5% of the value that should be attributed to these shares. However, that would be absolutely in contradiction to the articles of incorporation and wouldn't make sense in our view. So that means like overall, that's a very positive decision that provides very welcome clarifications, and also the the Luxembourg state did not file a claim against that decision. So it means this case is closed and should provide for additional legal certainty.
Yeah, and I think this one was waited for by a lot of people in the market because it kind of confirms what we all thought, but since the law wasn't totally clear and there had been some ambiguous written comments or in publications in the past, I think it was very good that this was confirmed. And I think the fact that the tax authorities didn't appeal it suggests that broadly it's their view as well. And therefore we have clarity of the fact that a share class buyback is considered a partial liquidation, so capital gains event, with of course the caveat that it just has to be done at the market value of that particular share class. But I think, as you were saying, Oliver, provided the articles are well drafted, that's what should be happening anyhow as a matter of company law.
Absolutely. Now, next slide. Now looking at case law of the Court of Justice of the European Union, and also being conscious of time, we have now like 4:37. So I might need a bit longer than expected, but I mean, I will make sure that we will not need much longer. So looking at the three decisions that have been coming out like at the end of 2022. So we had a decision in regard to the Fiat state aid case. Then we had a decision in regard to DAX 6 and the professional privilege. And last but not least, a decision in regard to the public ultimate beneficial owner register. All decisions are actually very positive. So let's look at the first one, the Fiat state aid case. Next slide here. So the Fiat state aid case was, I believe, the first state aid case that has been picked up by the EU Commission. So that was a situation around the Fiat group that have been implementing a Luxembourg company that performed like treasury functions and financing activities. And that was an investment that has been implemented, I believe, back in 2012. Since 2011 or beginning of 2011, the Luxembourg Tax Law authorities implemented or released their first transfer pricing circular in regard to financing activities. So that means like transfer pricing was at the time a very young discipline and emerged over time. But at that particular time, Luxembourg was really like kind of a beginner in this respect. So Fiat actually was the Fiat groups themselves that prepared a transfer pricing analysis which was very comprehensive and very well done at the time, and I had the occasion to look into that, as my employer was at the time was say like dealing with that. And I can say like, yeah, it was definitely like state of the art in 2012, much ahead of the time of that what other Luxembourg advisors did at the time. And in so far, I mean, one can have in principle a good feeling about the quality of the work that has been done. And so it was in principle then only like the say like advisory firm that was filing a ruling request in this respect, which has been confirmed by the Luxembourg tax authorities. And then in October 2015, the EU Commission has been picking up that case and considered that this ruling would entail state aid. Next slide. Now the first instance of the Court of Justice of the European Union still agreed with the EU Commission. However, now the Court of Justice of the European Union held that the decision of the EU Commission must be annulled. And that was because the EU Commission did not properly identify the reference legal system and could not prove that the Luxembourg tax authorities was granting a particular advantage to the taxpayer, which means the EU Commission was disregarding, for example, the Luxembourg transfer pricing circular that sets out how a Luxembourg company should determine an arm's length remuneration for financing activities. Given that Fiat was merely relying on that regime and no particular advantage has been granted to Fiat, it makes sense that Luxembourg did not grant any state aid to Fiat, but it was merely confirming that say like the arm's length nature of the remuneration in accordance with the applicable rules. And one must also say, like, yeah, at the time, tax rulings were still a very common thing. I mean, one would at the time obtain tax rulings for the most obvious situations. It was just like kind of a question of attitude. But since 2015, tax rulings and advanced pricing agreements hardly play any important role in the day-to-day practice of Luxembourg tax advice. Whether you want to add something?
No, I mean, I think again, I think it's a decision we were all waiting for. I think it's encouraging because it just shows that, you know, ultimately that even if the European Commission disagree with something, if the member state has applied their own law properly, they can't come back years later and say, well, with the benefit of hindsight and looking at what was done at the time through our today's prism, we think you could have done better. That doesn't constitute state aid, and I think that's common sense. And I think it's glad to see that the Court of Justice, you know, delivers fairly consistently common sense decisions, even if sometimes the application of state aid law gets much more political in practice.
Yeah, no, absolutely. Next slide. So the next decision is in regard to the mandatory disclosure regime, and here the lawyer-client privilege. A case being filed by, I believe, here the Belgium Lawyer Association. In principle, and I will not explain again like DAC 6 or the mandatory disclosure regime, but when there are reporting obligations under this regime,
Just checking.
Okay, so
we're still there. We thought we might have lost you for a minute there, but hopefully it was just our screen.
Okay, so in principle, potential reporting obligation rests with the so-called tax intermediary, which would be the tax advisor, a lawyer, or anyone else that is involved in tax advice. Now, many professions, and here the first one might be the lawyers, are protected by professional secrecy rules. So that means, in principle, they must not say like speak about the relationship or anything done for a client. Now, what the mandatory disclosure regime requires is that if a tax intermediary, for example, a lawyer, is prohibited from reporting because of professional secrecy rules, then such tax intermediary would need to reach out to all the other tax intermediaries and to inform them about potential reporting obligations. Next slide. Here the Court of Justice held that this would violate professional secrecy rules because the lawyer would somehow share their view on potential reporting obligations with another service provider. And here the intermediary, or the court held that the intermediary in these circumstances must inform the taxpayer, but not the other intermediaries. So what does that change in practice? Not that much, but because if there's something reportable, it needs to be reported, and then if the taxpayer is informed by the taxpayer, because then the reporting obligation would be shifted to the taxpayer. However, the positive element is that now the taxpayer is in control. Next slide. And just to even so that there's not really a tax topic, but I mean, as it's another decision that somehow is very common sense and beneficial, we also want to cover this one in regard to the public ultimate beneficial owner register. So Luxembourg adopted the public beneficial ownership register in 2019 in accordance with a new version of the AML directive. Yeah, so in principle, that means that anyone could ask for information about who is the beneficial owner of a company. Next slide. And here the Court of Justice of the European Union held that the access of the general public to this information would constitute an interference with the fundamental rights of taxpayers. After this decision, the Luxembourg legislator stopped the access of the general public, so that's positive. And I mean, while obviously tax authorities need to have all the information to properly levy the taxation, one can understand why people might have an interest to not make this information known to the general public, because it might increase the danger of people. Mm-hmm. Next slide. Probably just also to finish up, I mean, that have been now 3 decisions of the Court of Justice of the European Union, which are all very positive. So all in Q4 2022. So that was actually quite a bad quarter for the EU Commission. It also shows that somehow, the directives that are being drafted are probably more fueled by political will than first and foremost adhering to EU law, and then afterwards pushing through with the political will. So I guess that might be a conclusion here. And there seem to be more decisions in the pipeline also in regard to DAX 6, but to be seen. Now, just to give you a quick overview about the different developments at EU level. So here we will more or less quickly go through the different initiatives. You will find comprehensive publications on all these initiatives in the handout. But I mean, just to give you a quick update. So first we have ATOZ 3, the so-called Unshell directive, which would target so-called shell entities, or we should probably more precisely say letterbox companies. Letterbox companies, the entities are called in the German version of the directive, and I think it's probably more appropriate to refer to letterbox companies than the unclear term of shell entities. So the ATOZ 3 draft directive came out before the end of 2021. There have been discussions back and forth, but what we see is that there is a lot of disagreement between different member states. And so, by the end of last year, no say like compromise could be agreed on. We know that, or if we look to more or less current developments, so like the EU Parliament on the 17th of January adopted a resolution that would provide for say like reasonable amendments of the original draft directive. However, this resolution is not binding on the EU Commission, and we understand that currently there is another draft proposal being discussed, which has been launched by the Swedish presidency. There are also like several meetings in the next few months being scheduled in this respect. So the question is like, will there still be, say like an agreement before the end of the Swedish presidency, or will it rather be the second half of the year? So the signals that we are receiving is that it's probably more likely than not that it might rather be pushed back to the second half of this year, and then one need to see whether an agreement will be found. Next slide. Next slide. Next slide. Then there was another initiative which was called DEBRA, so Debt Equity Bias Reduction Allowance, that would foresee a notional deduction on additional equity contributions. At the same time, there would be an additional limitation on the deductibility of exceeding borrowing costs, like 15% should not be deductible. I mean, it really provided for like super complex rules how to determine, say like the allowance, would provide for like very complex anti-abuse provisions. So it was really not admirable, but in the end, this initiative has been suspended given the interaction with all the other initiatives. And so that is somewhat also showing, because here also member states have been pushing back quite a bit. And that shows when we look back to like probably the period 2016 until 2018 in the aftermath of the BEPS project, the Anti-Tax Avoidance Directive 1 and 2 and DAC 6 went through pretty smoothly. There was a lot of political pressure, and member states merely could probably oppose to the most or the most harmful elements of these directives. But it seems that now member states are asking more seriously questions whether certain initiatives make sense, and whether the EU Commission even has like the authority to become active in these fields. And normally the EU Commission only has say like a legal basis for action in the form of directive if there is something that is problematic for the internal market, for the functioning of the internal market, and say like tax law changes by EU member states cannot help, but it need to be in EU action. And so all these topics that we are currently discussing about, this is more than questionable. So therefore the question is, even do they have a legal basis? But the other point is like, yeah, apparently there seems to be some pushback for some of the new initiatives. And there we see like, yeah, ATOZ 3 should be adopted since long, but is still like being largely discussed. This initiative has been stopped. Next slide. Then another initiative would be the BEFIT initiative. So this is an abbreviation that stands for Business in Europe Framework for Income Taxation. So in essence, this initiative aims at implementing a common set of corporate tax rules for all Europe. So like, first of all, the income of, say like multinational groups should be determined in the same fashion all over Europe. And then afterwards, the overall profit would be allocated to the different member states based on formulary apportionment. And there, they would consider different factors, and that would obviously be still subject to discussion, like what factor should receive which value. This is more or less like a remake of the former CCCTB initiative, which has been stopped back in 2011. Now we need to understand a lot changed since then. And we have been a significant harmonization in EU tax laws, like via the Anti-Tax Avoidance Directive, the second Anti-Tax Avoidance Directive, DAC 6, the multilateral instrument changing tax treaties, and therefore the question is whether there's still like say like much of the purpose of the original CCCTB or proclaimed purpose of the old directive, and so like looking forward, the question is like, will all EU member states agree to give up their individual corporate income tax law, which normally should be adapted to their individual situation, meaning industry and economy, and provide specific incentives, and instead rely on a common set of tax rules for the EU, and then on formulary apportionment, which pretty much makes it a gambling how much tax revenues will be realized following such a change. Next slide. Then another initiative relates to say like or targets tax advisors that are called as enablers in this initiative. And according to the EU Commission, tax advisors still play an important role in tax avoidance and tax evasion. Now, taking one step back,
Which was news to us, by the way.
Absolutely, absolutely. So, no, just to make the point, I mean, first of all, what is tax evasion? Tax evasion is a criminal offense. Taxpayers and tax advisors definitely want to stay far away from anything like that. I mean, there might be significant punishment, and for tax advisors, they might lose their license. So, no incentive to go anywhere close to there. But even tax avoidance, which can be tackled by anti-abuse provisions, is not really a business model that would be successful in the long term, because like tax avoidance is like either relying on loopholes or a different tax treatment in different jurisdictions, and all these situations have technically been eliminated through the implementation of the Anti-Tax Avoidance Directive and the second Anti-Tax Avoidance Directive. So it means like before a tax advisor proposes an investment structure, he must analyze, is there a tax benefit? Whenever there's a tax benefit, there is a rule, an anti-abuse rule that could challenge this tax benefit. So the tax advisor need to analyze, are we out of reach of this anti-abuse rule? And so the answer to the question arguably would need to be yes, because otherwise one cannot suggest it. And if one reaches to the conclusion that one is out of reach of anti-abuse legislation, it's also not tax avoidance, but it's merely relying on the application of explicit tax law. Then it needs to be analyzed whether there are reporting obligations under DAC 6, the mandatory disclosure regime. And as we saw at the beginning of this section, we have a proposal in regard to an unshell directive, which would then require another analysis in regard to the substance of entities, which, by the way, is already somewhat included in DAC 6, where when we analyze the main benefit test, we already need to make an analysis of the substance of all the entities involved. So it means like this would just be another layer of the same. Apparently, the member states have already all the means to tackle tax avoidance and tax evasion. So therefore, one may ask the question, do they even have a legal basis to be active here? Next slide. Then as a quick update, so DAC 8 has been adopted, which requires like mandatory automatic exchange of information in regard to crypto assets. So it's inspired by the OECD work on the crypto asset reporting framework, and largely is a replication of CIS reporting, but in regard to crypto assets. The new framework would apply as from 2026, and it means like a fairly heavy regulation for a young industry. So obviously, like CIS is already quite heavy on banks, but on a fairly young crypto industry, that's quite something. Next slide. Then the implementation of DAC 7, Pillar 1. which provides obligations on digital platforms to report their income, or the income earned by sellers of goods and services. That is like an initiative that aims at the taxation of the digital economy. This directive should have been implemented by the end of last year, but many EU member states did not manage to implement this directive on time, including Luxembourg, but Luxembourg is now working on this. Next slide. Then last but not least, the initiative in regard to Pillar 2, the global minimum tax, which has been adopted by the end of last year. The directive need to be implemented before the end of 2023, before the end of this year, and would apply for tax years starting as from 2024, or say like after 31st of December 2023. So if you have like companies with diverging financial years, that might not be 2024 but 2025. In the context of alternative investments, Pillar 2 should be less relevant, but it cannot be excluded, in particular if we have like large groups like in insurance companies that would consolidate investments in an investment fund. And yeah, I mean, obviously for multinational groups, this change is triggering a lot of intricate tax issues, and I'm sure that this is what keeps the tax teams of multinationals awake at night these days.
Yeah, I think there was a question that came in over that, so that's effectively what we're talking about. I mean, Luxembourg is in the process of implementing this, as are most other states, but 31 December of this year is it's a hell of a deadline, yeah. So, but we're all committed to it, and there's a small amount of optionality in the European directive, which is being analysed in Luxembourg, as well as some other changes that need to be made potentially to the tax code as a result of Pillar 2. But at the moment, it's full steam ahead, and yeah, will be a game changer, I think, particularly in the corporate world, as you said, Oliver. Our analysis so far of its application in the fund world is effectively it will apply to a small subset of the alternative investment fund world, but it will cause quite a bit of work and heartburn probably to be able to fully eliminate all the other ones to arrive down to that last 1% of probably of the overall population, which will typically be cases where yeah, there is consolidation, either because of an investor that has a significant stake, or what we have seen occasionally is in listed fund groups where they may have funds that they consolidate if they seed it, or just because of their particular investment and control position in the fund. So relatively painless in terms of absolute monetary effect, but potentially quite a few headaches along the way in terms of screening the population of funds and then dealing with the consequences where there are potential investors that would trigger Pillar 2, so this 15% tax within a fund.
I think we would expect the draft law still like before the summer break,
yeah,
like June, July.
That's the plan.
So yeah, so that's the deadline at least that they're currently working towards. Next slide. Next slide. So yeah, we have nearly 5 minutes over time. Apologies for that, but I hope that the additional comments have been useful to capture the information that we provided. Probably just a little conclusion. So like in terms of like Luxembourg tax law changes, we saw some welcome clarifications. We also saw some debatable decisions of the Luxembourg courts, but we hope that say like follow-up decisions will provide more clarity and say like a good outcome and an outcome that would be consistent with a proper application of Luxembourg tax law. We have been seeing some very positive decision of the Court of Justice of the European Union. So like that was pretty much a plaque Q4 of the EU Commission. And last but not least, yeah, we saw the EU Commission is working on a number of initiatives, and it remains to be seen how successful these will be in terms of implementation. And now we would still be available for some questions.
So we have some that have come through on the on the printout here. There was a question about the most efficient way to pass the substance test under ATAD 3 for an investment company that doesn't have operations in Luxembourg. That's quite a complex question because, first of all, it depends what form of ATAD 3 we get. There is a whole area around proper board governance and whether that would constitute outsourcing. I think that there's a significant view in the marketplace that provided a board functions properly, it's hard to see how that particular management function is outsourced, and therefore potentially the fund doesn't go through the gateway. There's other ways around how the fund is run administratively as well. So the starting point is you're probably better off having substance, but if you don't, it doesn't necessarily mean that a specific entity is going to end up being covered by ATAD 3. So what else have we got? I think we talked about minimum 15% taxation, so that's pillar 2. There's a question then about the future of Luxembourg transfer pricing rules, guidance and practice. I guess that's probably quite a long one since it'll continue to evolve clearly, but we don't think there's necessarily anything specific big on the horizon unless you think of anything, Oliver, major that's changing. I think there's a question there about the impact of all of this on transfer pricing and software between India and the USA. I think, you know, unless it happens to be coming through a Luxembourg IP company, probably not much. However, some of these more broader things we've been discussing here clearly could have an impact, such as the Pillar 2 initiative, with still a question mark about how exactly that would or won't apply in the US. So I think that's it, and we're conscious of time. So unless there's any other questions that we haven't seen popping up here that pop up now, I think it just remains for us to thank everybody for your attention. We hope this was useful. As you can see, lots of change in the last 18 months. Some more change on the horizon, particularly Pillar 2, maybe ATAD 3, who knows. But in any event, yeah, just keep your eye on this space. And if we or any of our partners can help in Luxembourg or around the world, please reach out to us. We'd be happy to help.